the two sides of the coin, right? So they're trying to keep the economy growing and they're trying to keep inflation low.
Right.
And so after 2022, when inflation had skyrocketed, the Fed, using the main tool that they have in their toolbox to try to lower inflation, they were trying to increase rates. The reason you increase rates is because that means it costs more money for the banks to borrow money from one another from the federal funds,
Right.
That Fed funds rate, right? As that Fed funds rate goes up, it's more expensive for them to borrow money from one another, meaning they're going to then carry that cost on to its consumers in the form of higher interest rates on mortgages and car loans and personal loans and anything else that you need to get at the bank via, any kind of borrowing that you need to do, right?
Because what happens is most of the time the markets kind of know what they're going to do, or they think they know what they're going to do, and they usually get it right. So the value of equities that are out there, it's already kind of baked in, right? But then Powell starts taking questions. And the longer he stays on, the further the markets drop.
Welcome back to another edition of the Retirement Planning Happy Hour. I'm Eric Douglas, along with Chris Vaughn, Family Wealth Planning Partners, where we discuss all things related to your retirement and anything in the financial industry related to investments and whatnot. And we discuss all of these things over a glass of bourbon. So today we are doing something a little more topical. We try to stay away from doing things too terribly topical, but this will still be relevant over the next several months at least, because the Federal Reserve just got together and they decided to lower rates again.
Yesterday, as we're recording this.
Yes, so it's Halloween. So happy Halloween if you're obviously
we're
listening
wearing a little bit of orange today.
Listening to this a week or two late. So the Federal Reserve came in and decided to lower rates another quarter basis points. 25 basis points.
25 basis points,
a
right.
quarter of a percentage point. And we figured we would go ahead and we were kind of having this discussion with some clients around what this means, how it affects them. Figured that's typically where we get all of our best ideas for the podcast, right? Is through client conversations. Figured we would bring it out to the masses. And also, we're talking to one of our staff members, and we happen to mention that we are going to be talking about the Federal Reserve, and you could see her eyes.
The glossed over look.
You can very clearly see she had really no idea what we meant. So we figured we might even take a little bit of a step back and talk about what is the Federal Reserve before we get too terribly much into the decision that they made regarding the rate cut this month and what they might do in the future and how that affects you and your retirement and your financial portfolio. With that being said, that's the intro.
Let's talk bourbon.
Show us the bourbon.
So what we're going to be drinking today is Maker's Mark Cask Strength. And this is a limited bottling. That being said, I don't know how limited it is because this is a 750 milliliter bottle. It's pretty much the standard, and it was $47.99. So that's a pretty good price point for good bourbon right there. This particular one is 7 years, 2 months old. I don't believe, and I may be wrong, that regular Maker's Cask Strength is has an age statement on there. So, but one thing I thought would be neat, a friend of mine, we actually, when we did the Mary Dowling a couple of months ago, and it was one of those that we talked about how it checked every box, right? Well, we found out that checking every box is not necessarily good, and I had suggested that a friend of mine, that maybe he would experiment with cutting that down to a lower proof. Maybe we'd like it a little bit better. Well, he and I were talking about that yesterday, and I thought, let's try something else that checks some of the boxes. So this is a wheated bourbon. All Maker's Mark is wheated. They only use the one mash bill. But it is a cask strength. It is not a toasted or anything like that. And one thing I do want to point out, the difference between cask strength and full proof, and you see all these different things out there. Cask strength simply means that they take whatever was in the barrel out, and that's what you get. They don't cut it down at all. In fact, with this particular one, they do what's called screen filtering, which literally all they're doing is trying to get chunks of char and stuff like that out of it. That's it. Different than foolproof. Foolproof is whatever it went into the barrel. They then water it back down to get it back to that entry proof. So the entry proof on this is 110.0, right, which is low. Most bourbons go in at 125 proof, and that's so they get a better yield. And that includes the big dogs like well or full proof. That goes in at 125 proof, those types of things. When you use a lower entry proof, you don't get as good of a yield, but in theory, you get a lot better flavor for lower proof. Michter's is famous for that, as is Maker's Mark. So the proof on this, like I said, the barrel entry was 110. It came out at 112.6. So that's what we're drinking today. The topic that we'll come back to is 112.6 proof got as much flavor as the ones that are in the mid 120s and above? And that would be proof that what Maker's Mark does is actually a good thing in that case. So that's what we're drinking today. Let's move on and talk about probably the most exciting subject that we have ever talked about, very tongue-in-cheek.
You do realize we've talked about insurance on here, right?
I think the Fed is far more boring than insurance, and that is a statement. So where do we want to start? Let's start out with what it is. We were talking about, or you just mentioned, that one of our staff members asked, what are you all talking about today? And I said, we're talking about the Fed, and she got the glassy look. Right?
Yeah.
So let's make sure that everybody knows what the Fed is. You want to take that, or you want me to start with it?
Well, I mean, it's basically America's central bank.
Okay.
So it was created, and when we printed out some notes here just to kind of keep us on topic here, and as we go through the program today, we're getting professional in the way that we organize these episodes. We're using notes and everything. So, but basically, it was created in the early 1900s. They really have two mandates, and the mandate is to keep inflation low and to keep employment high. It's not like they have a lot of tools at their disposal to be able to do that.
Therein lies the issue, right?
Therein lies the issue, right? But I think sometimes they might believe or think that they are probably more powerful than they should be in a lot of cases, but that's another topic for another time. But essentially the way that they're structured, there's a board of governors headquartered in D.C. That's kind of the brains, if you will. And then they have a number of different regional banks. I think the closest one here might be the Federal Reserve in St. Louis, but there's Federal Reserves.
Something like that,
There's 12 different regional banks throughout the country. We didn't bother looking them all up. I know St. Louis, Atlanta,
like
Chicago. I think there's one in Dallas maybe, but regardless, it doesn't matter where they're all at. But there's 12 regional banks. Those are kind of the boots on the ground, if you will. Collectively, they typically, are making decisions around what to do with interest rates. So every few months, and we just did this week. This is why this is top of mind. Where the Federal Reserve Chairman, in this case, it's currently Jerome Powell, goes on TV and basically announces to the world what the Federal Reserve has decided to do with interest rates. And they tinker with interest rates because that's really the main tool that they have at their disposal,
right?
Is interest rates. And one of the biggest misconceptions that we constantly hear, and you see it all the time on TV, the Fed's raising rates, the Fed's lowering rates, and they think that automatically means or automatically correlates to things like mortgage interest rates or car loans or things like that interest rates that we pay kind of on a more daily basis throughout our lives. And that's not necessarily true. So when they're talking about raising and lowering interest rates, specifically what they're referring to is the Fed funds rate.
Right.
The Fed funds rate is what banks essentially charge each other to lend money to one another overnight. It's kind of the overnight deposit rate, if you will, that banks use. It's not the
interest rate that you and I would pay when we borrow money.
Correct, absolutely. It's basically the rate that banks are paying to loan money to each other overnight. The reason they have to do that, the reason why they have to loan each other money is because the Federal Reserve also comes up with the reserve requirements.
Yes.
That banks, they always have to keep a certain amount of money in reserves on hand in case there was any type of like a run on the bank, so to speak. Everyone came in all at once.
Which we've had. 1929, that was where it all started, was the run on the banks, right? It's to prevent that from happening again in theory.
And a run on the bank basically means everyone tries to come in at the same time and liquidate their accounts and take all of their money out. And so that's why banks are required to keep so much in reserves to be able to cover the claims paying ability of run on the bank or people that needing to withdraw their deposits, right? So they're really setting those reserve requirements, and they're also setting the rate at which banks lend money to one another to cover those reserves.
Right. So just to take that a step further, one of the things that you hear a lot is that the president is going to make the Fed do something, or Congress is going to make the Fed do something. It doesn't work that way. The Fed does not report to the executive branch. They are held accountable by the Congress. However, they're not technically part of the government, right? They are a separate entity. They're not part of the private sector, but they're also not part of the government itself. And that's was originally designed to keep them independent. However, they have become very politicized. And I think a big part of that is...
As everything has.
Everything else has. I think a big part of that is, I don't remember before the current chairman, when they would raise or lower rates, they would go on and have a 2-hour-long press conference that was covered. And you and I have a running joke. Every time Jerome Powell makes an announcement that they're either going to stand pat, they're going to raise, or they're going to lower rates, he then does a press conference. And I keep, Fox Business is running on the TV in my office, and we've been doing this for years. Eric will come into my office, and I'm sitting there watching the press conference, not screaming at the TV, but wanting to, right? He will come in and do exactly the same thing, because what happens is most of the time the markets kind of know what they're going to do, or they think they know what they're going to do, and they usually get it right.
But by the time they come and make the announcement, we pretty much already know what the announcement is going to be.
So the value of equities that are out there, it's already kind of baked in, right? But then Powell starts taking questions. And the longer he stays on, the further the markets drop. Yesterday, and this is kind of what got this subject going in our heads, yesterday, which was day before Halloween, they made an announcement. They dropped it 25 basis points, as you pointed out. The markets already expected that. But then he started talking about how 2 of the members of the Board of Governors dissented. Okay, one of them said they shouldn't change it. One of them said they should change it twice as much. That's a wash. Statistically, mathematically, it didn't do anything with it, right? But when he said there were dissenting members, the markets fell off a cliff. If you look at the trend line on the markets yesterday, everything was up, right? And then, bam, it is a straight downward line into negatives. And they mostly recovered by the end of the day. I think the NASDAQ ended up being up. But the point was that the longer he talks, the further it falls off that cliff.
Every time.
Every single time. And that's where we've sat in my office and done everything but throw stuff at the TV going, shut up, somebody cut his feed. It's not that what he's saying is wrong. It's that the more he talks, the more it spooks people, right? And I think that's because even people who think they understand what the Fed does don't really understand what the Fed does.
Yeah. And that just goes back to the point about most people think, oh, rates are going up. The Fed announced an interest rate increase. Rates are going to go up, or they're announcing a decrease, and I think that's going to correlate to everything else across the board. And I saw this, you see this mostly with mortgage interest rates, because interest rates are so high relative to where they were prior to 2022.
Right.
And we have this discussion with clients all the time about whether or not you should pay off a mortgage when you have a sub 3% interest rate. And, we have that discussion constantly. And I talk very openly with my clients about how I, refinance at the bottom, right, if you will.
Like
and so
2.5 something.
Yeah, I got 2.75 or something on my interest rate on my mortgage. I'll never pay another dime to it, right? Because rates will never be that low again in my lifetime. They will not. They never should have been that low in the first place. Right. But that's
another subject. We may get into that.
Well, we talk about it a little bit today, but but rates will just never be that low again.
Right.
But when they started to raise rates, what was happening, and this is kind of why this is always the two sides of the coin, right? So they're trying to keep the economy growing, and they're trying to keep inflation low.
Right.
And so after 2022, when inflation had skyrocketed, the Fed, using the main tool that they have in their toolbox to try to lower inflation, they were trying to increase rates. The reason you increase rates is because that means it costs more money for the banks to borrow money from one another, from the federal funds, that Fed funds rate, right? As that Fed funds rate goes up, it's more expensive for them to borrow money from one another, meaning they're going to then carry that cost on to its consumers in the form of higher interest rates on mortgages and car loans and personal loans and anything else that you need to get at the bank via, any kind of borrowing that you need to do, right? So because money became essentially more expensive, harder to access, that dwindled the supply of money in the economy and in turn started to lower inflation.
Right.
That's how we started to get lower inflation, was because they had raised interest rates so terribly high. There's another school of thought, in regards to the amount of government spending was really what caused inflation. We're not going to go down that road right now, but
in about 5 more minutes, right?
Yeah, we'll finish this bourbon, right? But ultimately, that's what we're looking at, right? And so now that you see they're starting to lower rates again, it's starting to juice the economy, right? So we're getting some pretty good earnings reports. We've had a pretty good economy. Economic numbers have been relatively good, knock on wood, through 2025, because we're starting to lower rates. And a lot of that has already been, to your point earlier, baked into the cake, because everyone kind of already knows that they're lowering rates this year. This was the second rate cut this year. They kind of said at the beginning of the year they were planning to do 2 or 3. So the economy was already baking in future rate cuts. Hence, I think a lot of the economic numbers have been pretty good because of that in relation to specifically valuations of stocks. So you're seeing stock valuations, being influenced because they were already expecting rates to go down. So now that the time we actually had the announcement of the second rate cut on the year, those prices have already been baked into this. Those rates have already been baked into the price of the stocks, right? So there's not really, once again, the announcement is not the news. The news is the press conference.
Right. And, okay, so let me go back to that. One of the things that he said yesterday was that there were 2 dissenters among the Board of Governors. It's the fact that they dissented, that they're not all in lockstep with each other, I think, that caused some panic. But he said something else, and you just kind of alluded to this. They have been hinting for months that there would be 2 more reductions in the discount rate this year, right? So we got the one yesterday, but then he suggested that we may not have that at the next meeting in December. Well, that caused everybody to panic, because they were kind of thinking, yeah, we're gonna get 2 of these rate cuts. Well, now there's a thought process that says we're not going to get them. So I'm explaining this to my wife. So my wife is like the average person that's probably listening to this. She gets all of her news from me, because she avoids listening or watching this stuff. She doesn't get it. She doesn't want to get it. And all she knows is the more news she watches, the worse a mood she's in. So she's wise enough to just stay away from it. But I got home last night and I was talking about, Powell was talking, and the more he talked, the more things went on. And Kathy says to me, he's aware that that's happening, right? I said, well, of course, he's not stupid and he's not blind. And she said, then he's doing it because he likes the attention. And it's like, wow, what an amazing revelatory comment that she made. And that's when I went back and I thought, you know what? I don't remember previous Fed chairmen doing press conferences at all. I definitely don't remember them every single time for long periods of time.
Yeah.
I just don't remember that. So,
and if they did do it, it certainly wasn't making news, and it wasn't nearly as correlated with the economy, right? Because so many of these announcements are becoming correlated with just general economic conditions, and we shouldn't be on pins and needles waiting for what the Federal Reserve is going to decide. It should be very anticlimactic, unfortunately, just within our 24-hour news cycle, how everything is politicized. Anyone who thinks the Federal Reserve isn't independent, by the way, go look up some of President Trump's recent tweets around his opinions around Jerome Powell and what he should do with himself, right?
Well, and full disclosure, Powell's term is over. It's next year. I want to say in June.
It's coming up, yeah.
So we will be getting a new Fed president, or chairman, excuse me, because he's not going to be nominated to fulfill the role again. That's not going to happen. I don't even know that they're allowed to. But I thought it might be interesting. I want to revisit something that you said just to make sure that people understand the purpose of raising and lowering that Fed funds rate. Yeah. So that's the rate at which the Fed is loaning money to banks, and that banks are loaning each other money overnight, right? It has nothing to do with printing money. That's another one that I've heard. The Treasury prints money, right? The Fed is a totally different entity. They are not the same thing. They're barely related. But they're raising the rate because people are spending money too quickly, right? You made the comment that there's too much money in the economy. I remember from in school studying the M1, the M2, the M3. You want to bore somebody. start talking about those. But it's basically there's too much money in the economy, and therefore people are buying things too quickly. When they do that, inflation goes up, right? So they raise the rates in order to make things more expensive, which slows things down.
Well, and that's what happened with COVID during the government spending.
Well,
Everyone
okay,
got all this money in their pocket.
That's a really good lead in. I went and I pulled all the Fed changes that they've made since March of 2020 when the COVID lockdown started. Now, I want to remind you that the rates were already pretty low, and that was part of the problem. If you want to know what caused all the inflation that we had in 2022, for example, you got to go back and look. The rates were too low prior to COVID.
Yep.
And that was Trump's administration and Obama administration. It actually stretches back to 2008, right? They got low and they stayed low, I would argue, for way too long, right? People were loving how cheap things were, and inflation was not going up. So the inflation that happened really was 10 plus years of it not going up as much as it should have. So the economy had to naturally catch itself up.
We had unnaturally low inflation for a long period of time. So we kind of got it all at once.
So, for example, and keep in mind, when you're going to borrow money, you're not borrowing it at the Fed funds rate. That's what the bank gets it for. They're going to charge more than that because that's how they make money.
Yep.
So I was talking to...
And I will say mortgage rates and interest rates on commercial loans are far more dictated by the free market.
Yes, absolutely.
To a far greater degree, because when you go to take out a mortgage, essentially what happens is most of the time that mortgage is being packaged and sold as a piece or a part of a mortgage-backed security that's going to be sold on the free market. Right?
So I was actually in a networking group that I'm in Wednesday morning this week. Our commercial banker was talking about HELOCs, so home equity lines of credit. Those are usually variable. But he was talking about their bank was offering a 7% HELOC right now. Well, at the time on Wednesday, the Fed funds rate was 4.25. Yet that bank is offering 7. Well, that's where they're making their money. I mean, it's just how it works. But anyway, you go back to the 2010s, right? So the Obama and the first Trump administration. Everything was too low, but the inflation was not going up. Okay, then COVID hits, and then the government dumped trillions of dollars into the economy. And that basically caused everybody to start spending money. Now think about this. We were all sitting at home. We were bored out of our minds. You were looking at the walls going, I don't like the color of that wall anymore. I think I'll have that painted. You couldn't get a painter. Remember that? You could not get a painter. I don't know that they're caught up yet. And people started doing decks on their houses and stuff like that because all of a sudden they had all this money.
Couldn't travel.
They couldn't travel, so they're spending money. Amazon went through the roof because we could still order things online. Well, all of that money getting dumped into the economy and people being bored, they start spending that money. Well, that causes inflation to spike, right? So you've already got this very, very low discount rate, and the Fed had to start raising rates, and they had to start raising rates quickly. Right? So I pulled the list of just how quickly they did it.
And because rates were so low, they had to raise them so high.
Yeah, they went crazy, and they went crazy overnight. So here we go. In March of 2020, they went down 1.5 percentage points. That's 150 basis points for people who like to talk like we do.
I forgot about that. Yeah.
And that was to stimulate the economy because everybody was scared. So you already had a rate that was at 1.75, right? And they dropped it to 0.25 overnight. That was March 16th of 2020.
And the market bottomed about a week after that.
Yep.
A week or two after that.
Something like that. And oh my gosh. Okay, so in March of 2022, so 2 years later, they say, okay, we got to slow this inflation thing down because it's going nuts, right? March, they went up 25 basis points. June, so just 3 months later, they go up 1.25%, so 125 basis points. July, they went up 0.75%. September, 0.5%. November, 1.0%. So now we're all the way up to 4% in less than a year from 0.25. Okay? Then they kept going. So December of that year, 0.5. February of 2023, 0.25. March, 0.25. May, 0.25. July, 0.25. You noticing a trend? So we're all the way up by July of 2023. That was the peak. We're all the way up to 5.5% is now the Fed funds rate from 0.25 just a little bit, like a year and a half. Just a little over a year earlier. That's a massive spike, right? So then the next question comes in, well, you know what? Why didn't inflation stop? If they were raising the rates that fast, why didn't inflation stop, right? Well, when you are sitting in a house and you are hot in your house, right? It's very warm in here. I'm going to go turn the temperature on the air conditioner down a couple of degrees. Do you instantly go,
yeah,
right? No, you don't. It takes, I don't know about your house. At my house, it's half an hour before it's a noticeable difference, right? Maybe longer than that. I think this kind of works the same way. It takes time for you to feel it. And then there's the other part to that. I think too many people do not understand that reducing the rate of inflation does not mean reducing the price of things. It means reducing the rate at which they get more expensive. What you are buying is not going to go down. It is where it is. There will be some exceptions, obviously. But if you're paying, say, $1,000 for a product or a service now because it went up so fast during 2022, it's not going to go back to 500, right? It's just not going to go up as fast as what it was. So the theory now is, now that they're reducing, they started reducing in September of last year. So we've been a little over a year to it now. We've now had 5 reductions in the discount rate. So we are back to 4.0%, right, over that window of time. And everybody says, well, it doesn't feel like inflation is going down. Inflation is pretty much back to, it's a little bit above where they want it to be. They want it to be theoretically at 2.0.
Yeah, 2% is kind of always the target.
That's their target. But historically, it's about 3% is what it really is. So we're right back into that window. But people don't feel it because things are still more expensive. It's still more expensive to buy a house because you're going to be paying 6 or 7% interest.
Well, it was the shock of the inflation too, and people still have not gotten over that. The old analogy of the frog in the boiling water, right? So if you drop a frog in boiling water, it's going to immediately jump out. If you drop it in cold water and then heat the water up, it's going to boil alive, right? Because it happens slowly. Well, the shock of the inflation that we had in 2022 or prior to 2022, which led to the interest rate discussions and decisions that were made during that time to raise rates so quickly, that was just a shock to the system. And so because we weren't used to getting inflation like that, specifically in most people's lifetimes at this point, because the last time we had any kind of real inflationary issues like that was back in the 70s during the gas shortage and the gas crisis, right? So people just weren't used to living like that. Those prices are never going to go back down to what they were.
Correct.
And I've had enough discussions with people, and they don't like it when I say it, but higher prices are here to stay. What we need to hope for is that they don't continue to increase anymore, right? Or at least with anything above a reasonable rate.
Yeah. So. It's interesting that you pointed back the last time that we had an inflationary cycle that was this high was the late 70s. Well, okay, so here in the notes that we had, there was a section about some of the biggest things that the Fed has done, at least in our lifetimes. The 1980s, late 70s, 80s, what this is calling in the Volcker era. I don't remember his first name, but I do remember.
Paul Volcker.
Thank you, Paul Volcker. I remember my family hated him. Right now, I was born in 71, so I'm still very much a kid when all this is going on. I remember them hating him, and I remember they'd show him on the news, and my parents would be like, he's the one causing all the problems. Really? Okay, well, I didn't understand how that works. Well, I understand why my parents hated it so badly. Dad was in the real estate business.
Yeah. Right?
So the discount rate was over 15%. So for those of you who are complaining about how high it's been in the last couple of years, we're not even close to what it was then, not a third of what it was. I remember Dad literally knocking on people's doors to see if they wanted to sell their house because he was so desperate for business. And you were getting interest rates of 17, 18%. I cannot imagine what our houses would cost.
Oh, my dad has reminded me many, many times. It was like a 15, 16% interest rate in the house that I was born in.
Yeah, and just insane numbers. Okay, well, now, perspective, I know why my dad couldn't stand Paul Volcker, because it was costing him money. But flip that to the other side. When you are a saver, high interest rates are a good thing. So, we've complained for years to the point I don't remember the last time that anybody said that a savings account was a good investment because you were getting a half or maybe 1% on your savings account. But that's because the Fed rate has been so low for so long. But I remember in the 90s when my wife and I got married, you could get 6 or 7% on a savings account, right? But we also had a much, much higher lending rate because the Fed funds rate was different back then. So it's cyclical. There's a couple other things here. The great financial crisis. You remember how low rates went back then?
Oh, they went to zero.
Zero.
Yeah.
They went to zero. I don't even know how that works. I mean, that's beyond understanding right there. You look like you were going to say something on that.
Well, it's interesting you brought up the great financial crisis, right? The Great Recession from 08, 09. So many of our issues today can be traced back to them.
Absolutely.
The decisions that were made in 2008, 2009 in response to, obviously, the collapse of the markets. And you could even go back probably to the Great Depression because a lot of people argue the New Deal made things worse.
I would be one of them.
Before it made things better, right? I mean, obviously I wasn't around, but, there's a lot of history around that. And, conventional wisdom will tell you that's what saved the economy. But when you actually go back and look at it further.
World War II saved the economy.
Yeah, World War II was what saved the economy. It had nothing to do with the New Deal. But essentially, there's a lot of people out there that if you had looked and paid attention to 2008 and you would just let a lot of those banks fail that needed to fail, we probably would have climbed out of 08 a lot more quickly than we did. I probably wouldn't have been nearly as bad. But we flooded the system with all kinds of money. TARP bailout, anybody remember that? The single most
useless.
Hated, useless, but the single most hated bill that had ever passed, right? It had the highest unapproval rating of any bill that's ever passed through Congress. So much of the policy, that was really where, whenever I think back to it, 08, 09 was when we saw kind of fiscal policy, in the free market start to correlate to a far greater degree than really had ever happened before, in my opinion anyway, at least certainly in my lifetime. And so much of our free market now is so dictated by what happens through fiscal policy. That's why ever since that time, ever since 2008, 2009, there's been a much greater focus on the Federal Reserve. And what is the Federal Reserve going to do with rates? And, how is that going to affect the economy? And the economy is going to respond, and the stock markets are going to respond. And that's why we all have to gather around the TV and watch Jerome Powell at these press conferences start opening his mouth and answer these questions. And that's why the stock market tanks, It never goes up when he answers these questions.
Just a random thought. I think we both need to go buy foam bricks. So for the rest of the cycle, anytime that they're on making announcements and we're watching it, without destroying our TVs, we can throw a brick at Jerome Powell going, please just stop talking. We don't disagree with you, but the more you talk, the worse you make it. Something that I heard you say a second ago, we trace this back to bad decisions around 2008. If we'd have just let some of these banks fail, we would have been better off. And then you mentioned the Depression, right? Okay, there were a lot of government policies that kind of brought on these problems. I would even go back, and I'm going down a totally different rabbit hole right now. If you look back at the Great Recession in 08 and you trace it back to its beginnings, it actually started about 06 with real estate prices, right? And what happened was there were so many defaults on mortgages because lenders were, oh my gosh, they would lend to anybody. I mean anybody.
Yeah, I was in the business at that time.
Right? And it was, people were making money hand over fist because they were loaning money. But then here's the thing. It wasn't the banks that were loaning the money and then sitting on these loans. They were loaning the money and then they would sell packaged loans, typically 100 at a time. They would sell them back to these organizations you might have heard of.
Fannie Mae,
Freddie Mac, right? Which are government organizations, right? So the government had dictated, we want to make sure that everybody gets to live the American dream. Everybody deserves a house. Credit-wise, that's not true.
And at all.
Everybody deserves the opportunity, but some people they don't have the financial ability. And money was being loaned out that shouldn't have been.
And maybe we need to do an episode one time of my experiences during that time.
That might be a
fun
episode.
My first job out of college when I graduated in 2004, I was a mortgage broker. And I was doing I was brokering mortgages around the country. So I was working with lenders in Florida, California, everywhere in between. And you would get some of these appraisals back on properties in Oakland and San Diego, and you would see that secretaries that were making $40,000, $50,000 a year were buying
$1 million+ houses,
$400,000 or $500,000 houses.
Crazy stuff.
And I was like, how are you? And I was doing the loans.
Yeah.
And I was seeing what some of these people were getting approved for at 100%, 120% loan to value ratios. And so I was not surprised. Long story short, the Great Recession did not surprise me.
Yeah. It comes back. My point is government policies, albeit well-intended, have a tendency to have some really nasty ripple effects. So then those go through the economy, and then the Fed tries to react because the Fed is reactionary, right? Yet at the same time, the argument the example that I made, you're trying to lower the temperature in your house, so you turn the air conditioning temperature down a couple degrees, but it takes time. So you're reacting to an existing problem instead of being proactive to it, knowing that it's going to take some time before it really has an impact. And that's where the Fed actually takes a bad rap, right? How come they won't do something? They have. It just takes time for it to go into effect.
Yeah, and ultimately, whenever it comes to any of these decisions, because one thing you hear about, the Fed knows what they're doing, yet if that were the case, you would not hear constant arguing on cable news channels about whatever decisions that the Fed is making.
There's that theme we keep saying, stop watching the news, you'll be a happier person.
No kidding. But the problem with any Fed decisions that get made, you won't know if they were the right decisions really until years later, at a minimum months. But really years later, you're not going to know if those decisions were the right ones that were made or not.
Right, because it takes time for that to percolate through the economy. I mean, if you think about all the different little factors that it has to go through before you actually feel it.
Yeah, and a lot of people, especially if you were in, for example, real estate, you used your dad as an example, you hated what the Fed was doing with interest rates going back to 2022. Right. You could argue, given with what the Fed was working with, once again, I don't think that the Federal Reserve lowering rates is what caused the inflation. I think that had a lot more to do with government spending.
Agreed.
But once the money was spent, the Federal Reserve had to kind of come in and do what they could to fix inflation. Inflation was out of control. They came in and they increased rates substantially. I think they probably had to, and in retrospect, actually, I think they kind of did a pretty good job. Yeah. I hate to say that, and I definitely wasn't always sure that they were during that time.
Yep.
But they raised rates, and you heard a lot back then about a soft landing.
Soft landing. Oh,
the soft landing
hate that
where
phrase.
There was a soft landing where they're going to navigate this very specific area. Like they're going to ride this line between lowering inflation but not crashing the economy, because that was always the big concern. They were going to raise rates too high to a point that the economy was going to utterly collapse. That didn't happen. Now, 2022 was a bad year for stocks, but inflation came down. The economy recovered relatively quickly. And knock on wood, things have been pretty good since. Yep. So, always knock on wood, right? Because, the other shoe will drop at some point. So you could argue that the Federal Reserve made some good decisions coming out of 2022. Now, whether or not they're continuing to make good decisions, I don't know.
We won't know for months or years.
We won't know. There's a lot of people out there suggesting that they should be more adamant about lowering rates. I've heard the argument, like, listen, the government's not going to stop spending money. To some degree, you're going to have to get used to inflation to a higher degree. You're just going to have to. And one way to deal with that is to keep rates lower in order to keep the economy juiced.
Right.
For lack of a better term. So...
Well, it's easy to Monday morning quarterback.
Yeah.
I thought they were raising rates. It wasn't that they were raising them too high. It's that they were raising them too rapidly in 2022. To go back to your point, I don't know that was the wrong thing to do. The real problem, in my opinion, was we'd had too many years of too low.
I agree with that
And at
too.
the time, well, okay,
And
I'll pick on myself.
Yeah.
I was loving life. That was awesome because interest rates were low, so clients were making good money on stocks, right, and on equities-based investments. So I'm in that business. That's helping me out, right? But in retrospect, they should have been ticking that back up much more rapidly than what they did because it lended to 2021, 2022.
So where you want to go from there? That's probably a good time to take a break.
I want to talk about bourbon.
I finished mine.
Wow.
That's
Okay. So I'm
that's
going
probably
to
a
go
good sign.
with your rating this as a pretty good one.
It is pretty good. You mentioned it smelled like right before we started filming. You mentioned you took a sniff and it smelled like butter. That is probably the best description. There's it coated. There was a lot of coating. There's a lot of chew on this one. Very smooth. As you swallowed it down, but a lot of flavor on this. Very buttery. That initial taste. And this is pretty much the case with every bourbon, right? Is going to be a little harsher than the others, but after you had one or two sips, it started going down really smooth. The chew was about right.
Well, something
a lot
that
of butter,
I will
a
point
lot
out,
of honey.
when you talk about that first hit is a little bit harsher than the rest of them.
Yeah.
When you go to a bourbon tasting where there's a lot of things out there for you to try, right? So when I go to a bourbon event, there might be 20, there might be 200 bottles out there. You'll never try them all, so you're just taking little bitty amounts. But there's kind of a rule that says always start with something low proof. Get your palate used to what's coming. Because then the higher proofs, there's almost always stuff that's north of 130 proof when I go to an event. If you start with that, the burn is so intense that, first of all, you're not going to enjoy it as much as what you should. And second of all, it burns out your palate. You can't taste the 90 proof stuff, right? It just has no flavor at that point in time. I have never had this particular incarnation before.
Neither have I. Yeah.
But I would buy another bottle of this in a heartbeat.
What was the?
This was $47.99.
That's a good price.
And that's retail.
Yeah.
Wow. Just fantastic. And it did say, limited bottling, but the Maker's Mark cask strength, that's something that is readily available. You can get that pretty much anywhere for $47, $48. That's retail. I think this one having an age statement is what makes it a little bit different. I don't believe they put an age statement on all the rest of their cask strength. Right now, I don't care because at that price point, this is a really, really good bottle. If I have a complaint, it's not about this product. It's about Maker's Mark in general with their corks. So if you're listening to me, Maker's Mark, this one actually I was pleasantly surprised. That one has a real cork. Okay, fine. Most of them have synthetic corks nowadays. But the cap and the cork are glued together, and they don't use enough glue.
And it comes off.
And it comes off, and then you have to get pliers out to get the rest of the cork out. Or I've actually had to get out a wine corkscrew to get it out. It's like, okay, guys, charge me an extra penny and put another dollop of glue in there when you do that. I've got multiple bottles of Maker's Mark that I've had that problem with. But I'm really stretching to have a complaint here because that is a fantastic pour.
Yeah, and you've heard me say this plenty of times. It's all about value for me. I mean, you can find a better bourbon at a higher price point, but at some point it just becomes, is the juice worth the squeeze? Under $50 is kind of my sweet spot. This is a good pour for under $50.
And I'll be real honest with you. If I think that this could compete with a lot of the stuff that I've had in the $90 to $100 range that I liked. This is at the price point. This is out of this world.
Yeah.
Change the price point. This is a competitor with most of the stuff that's out there that's a little bit more eclectic or difficult to find at higher price points. This is well done, Maker's Mark.
Yep.
So I don't think, and you know what? I haven't even tried to cut this yet. I will.
I didn't even
just
bother.
to see. You don't really need to.
Didn't need
I
to,
will
yeah.
see if it improves it at all. A little bit heavy there, but that's okay. All right. So, what else do we want to go into involving the Fed? Just talking about the Fed in general is a great way to put somebody to sleep. I mean, if you're the typical person out here and you're having a little bit of trouble sleeping, if you got a little insomnia problems, maybe play this podcast back when you're trying to fall asleep, because this is just a boring subject.
I don't know if that's the best roaring endorsement of our podcast, so maybe don't say that out loud.
Okay, don't do that.
But I think let's maybe go here as far as how this decision affects you. And for the most part, I don't think most people are going to be terribly affected. What's been interesting to see through the rate cuts that have occurred this year, mortgage interest rates have stayed pretty steady. They haven't really dropped nearly as much. Mm-hmm. You can argue, a couple of different reasons potentially why, but rates on the commercial side that are being offered to consumers have not really dropped in response to what what the Federal Reserve is doing with the Fed funds rate. A lot of that has to do, going back to mortgage-backed securities. So many of these loans are then packaged and sold as a group, as a security, after they've been taken out. So at the end of the day, what banks are offering to their consumers are going to be rates that are going to be able for them to be sold on the secondary market, in the free market, right?
Right.
So that's ultimately what dictates far more than whatever the Federal Reserve or whatever the Fed funds rate is. The rates that they're able to dictate from the free market when they sell these mortgage-backed securities, that's what's going to dictate the rates that you and I have to pay when we go to refinance. The other issue too is there's just not a lot of demand, right? Yeah. Because so many people, I use myself as the example all the time, and I already did. I've got a sub 3% interest rate. I'm not trying to go refinance. The banks aren't making any money off of me right now. I'm a bank's worst customer right now. They can't sell anything to me when it comes to loan products because I will not pay my mortgage off early, unless I happen to move or something at some point, which my wife would probably like to. But that's another story. There's just so many people like me that refinanced, a few years back when rates were ridiculously low, abnormally low, that, there's so many people. And plus, a lot of people learned their lessons from 2008 and 2009, because what drove those crises were people that were taking out too much money than they could afford. Well, a lot of people learned their lesson, and you know what a lot of people did? They paid off their mortgage. Mm-hmm. So the number, and everyone says, I always laugh when people are predicting another 2008. We're not going to have another 2008. It will not happen.
You'll have new problems.
You'll have something else.
It'll be different.
But it won't be another 2008 because we're not lending to people that can't afford it. And the number of homes that are debt-free, that are mortgage-free, is the highest it's ever been. It's like 45% of all homes are owned free and clear. That number was nowhere near what it is today back in 2008. So that, and everyone's always like, well, how is housing pricing? How is housing prices continuing to increase? That's why, because people own their homes free and clear. Well, they can sell their current homes and move into a new home relatively cheaply, right? That's what's continuing to keep real estate afloat. That and just a lack of supply. Building became a lot more expensive, and so you're just not seeing as much supply in relation to demand when it comes to real estate, right? So that's always the issue. Everything in the economy always comes down to supply and demand, right? Any question.
Economics 101. That was the first thing that we were talking.
Everything that we ever talk about on this podcast, if you evaluate it through the lens of, how much supply and how much demand, and you can usually answer, find the answers to the questions when you figure out, the ratio between the two, right? So.
So just a couple more things before we wrap this up. There is a ripple effect to changes in the rate when the Fed makes them, right? And it does impact a lot of things. So you just pointed out the most obvious one. When we borrow money and in large sums. So for the average consumer out there, the biggest loan you're ever going to take out is on your home, right? So a couple of things happened. So you were a perfect example. You refinanced your home back in 2021 or whatever it was, and you got, to your words, a ridiculously low rate. And I think that's an apt description. Then you take the other side of that equation, right? People were buying homes because they could get them at these ridiculously low rates. And in my case, the neighborhood that my wife and I were in really changed quickly. We had in one summer where we lived, you got 3 houses across the street from you and you got neighbors on both sides. The neighbor that we had on one side, we never really had anything to do with them. They're very, to themselves. We were friends with the people that were next door to us and all 3 across the street from us. In one summer, we lost all 4 of the neighbors that we were friends with. And all 4 of the ones that bought, we didn't like. Right? Just one of those random things. But it put us into a situation where our timetable for relocating to what we planned to be our forever home was advanced, right? And we had to, in order to accomplish that goal, we had to buy at a higher interest rate, which means couldn't buy quite as much as what I really wanted. You know what I mean? So you have to settle for certain things. And now, unlike you, I'm watching rates to drop enough because I would love to refinance, right? I've already done it once, and make no mistake, I would do it again if the rates dropped enough. So there is a ripple effect in the real estate, but there's a ripple effect in other things too. And this is something that our firm has been screaming about, along with lots of other people out there. There's books and stuff on it. There was a point in time when you could have a safe investment, quote unquote safe, by going into the bond market.
Yep.
The whole concept of the 60-40 portfolio was based upon, now you're retired, 60% of your investments are still in equity, so they have the ability to grow, and 40% are in income or bond-based things because that's your safe space. And we've said this a million times. Because the Fed has become more active, and that's a genie you can't put back in the bottle, that bond market has become more correlated. I've heard you say this more times than I care to think about. In 2022, when the equities markets dropped, 21, 22%, that wasn't the problem. That's not a glitch in the market. It's a feature of the market. We gave back some of what we've made over the last 3 years. And over that 4-year window, we were still profitable. It was the bond markets, which I believe the ag was down 15-something%.
15.5 or something, yeah.
The safety margin that people had was no longer there in the way that those portfolios were designed.
And the bond market does not recover like the stock market does.
No, it can't. It's not supposed to, excuse me.
And it hasn't. It has not recovered from that drop in 2022.
Right.
It's worth noting. So that bond market was down 15%. It's still down.
Yeah.
It's not down as much. It's come back a little bit, but it hasn't come back to what it was.
So it has rearranged. This is another one where this rippling effect has an impact on all of us. It has an impact on our industry because one of two things is going to happen to us as advisors. Either we can continue to do things the way that it has always been done, which there's a lot of advisors that do that, or you can rethink the way you go about taking care of your clients' money. It takes the average consumer out there who is at or in, nearing or in retirement. They have to rethink the way that they want to go about spending their money because now the way that they had their money invested just changed. And it has changed because of that rippling effect of a very active Fed.
Mm-hmm. And it changed the way that we do business.
Absolutely.
And the way that we
were
manage,
one of them that changed. Lots of others
we
did too.
were ahead of the curve. I think a lot of your willingness to change is dependent upon how old you are and how long you've been in the business. But, everyone says, a lot of people, at least the old timers in our business, always like to think that everything is the same, right? Mm-hmm. It's a different cycle. Well, things are different. Things really are different than they were in the 80s, and then the 80s were vastly different than the 90s and the early 2000s, et cetera, right? And really, I keep going back to 2008, but that was when the markets, and the government became so intercorrelated, intertwined, that government decisions are now having an effect on the economy, on the stock market. A direct response,
That's
right?
the key phrase there.
And so the decisions that are made at the Federal Reserve, decisions that are made by Congress, those decisions have a direct correlation to what we are seeing in the markets, and more specifically in the bond markets, because the bond markets will typically react sometimes even more so, or even prior to the stock markets. And a lot of it's interesting. We go back to when Trump was talking about tariffs at the beginning of this year and the Liberation Day stuff. A lot of people were thinking that, oh, well, the stock market's crashing. That's why he changed course on some of his tariffs. That's not why he changed course. No. He changed course because the bond market was reacting.
Yep, that's exactly right.
And when the bond market started reacting to the tariff information, that was the catalyst to get him to change his stance and to kind of
be a little bit more flexible.
Be a little bit more flexible on those, some of those tariffs that he was throwing up, right? And the bond market has a lot of influence, and when the bond market breaks like it did in 2002, that is a huge, huge issue, a much bigger issue than if the stock market has a bad year, because the stock market can recover fairly quickly, much more quickly than the bond market is ever designed to do.
Yep.
So we changed the way that we manage money, the way that we manage bonds, pretty significantly, 4 years ago, 4 years ago. It's been a great change. It's been good for us. Been good for our clients as well. I should add. But that's our little plug.
I'm going to wrap this up by saying the way that this ripple effect from Fed decisions really affects everybody. You can say that the stock markets don't affect me, then you don't understand what they are, because they affect your 401k, they affect your pension, they affect so many things that are out there. Whether you like it or not, it does have an impact on you. But the bond markets are the stabilizing feature, and the bond markets are directly related to the decisions that the Fed makes, because the Fed rate is the cost of borrowing money between banks, and bonds are loans. That's what they are.
They're debt.
So they are debt. They are directly correlated. So what the Fed does have an impact on everybody, even though it may not seem like it. Well, I'm not in the market to buy a house right now because I'm at 2.5%, or my house is paid off and I'm staying here till I die. It still impacts you. So that's one of those things. I would say this, and I'm going to toot our horn when I say this. If you are at or in retirement and you are still in a 60-40 portfolio, and it's pretty easy to calculate that, you really need to go talk to your advisor and say, why am I still in something that so many people in the industry believe this has gone the way of the dodo for a reason?
At least a traditional 60-40.
The traditional 60-40. And it's based upon the activity of the Fed.
Yeah, and you're basing your retirement portfolio is based on what worked in the 80s and the 90s.
Yeah.
Basically. So.
All right. Let's wrap that up. I'm going to make one more comment because I did put a little bit of water in this afterwards.
All right.
Just to let you know. You need to go back and try that, because if you like that buttery part at the beginning, it got more buttery, which is I hate to use the word smooth with bourbon. I hate that phrase. Yeah. Wow, is that smooth? It is.
Well, I got to drive.
It's even better after a couple of more drops of water.
I got to drive relatively soon, so there will be no more for me while I'm
No more for me. I've got to drive. I am headed to a football game tomorrow morning. Hopefully, I will be in a very good mood.
Tennessee?
Late day. Yeah, Oklahoma at Tennessee.
Yeah, okay.
So we will be down there tomorrow. It is dark mode, so basically a lot of Tennessee fans sitting outside and drinking alcohol all day long, and then going into a stadium and them turning all the lights off and everybody screaming because the players are wearing black.
Well, it'll
be fun.
This is all news to me, because my understanding was the football season was over.
Well, that's the UK perception. It's basketball season now.
It's basketball season. I don't know what you're talking about. Football season's over.
I believe they lost an exhibition game last night. That was...
And so I want to thank everyone for joining us.
Sorry, I had to do that.
For another edition of the Retirement Planning Happy Hour. This is Eric Douglas. This is Chris Vaughn, who I'm not very happy with right now for bringing that up.
It's an exhibition. We'll be all right. We'll be all right.
We will see you next time, next week. If you have any questions as it relates to your retirement, investments, financial portfolio, if you have a traditional 60-40 and you want to have it reevaluated, please give us a call. Number and link to our website is in the show notes. Thank you for joining. Until next time.